Imagine you plant one tiny seed in the ground today. You water it, you give it sunlight, and then you wait. At first, nothing seems to happen. Weeks later, a small green sprout appears. Years later, you have a big tree with lots of fruit. That is what investing is like. In this video, we're going to explain what investing really means, why people do it, and how it can help your money grow over many years. No big words, no confusing charts, just simple ideas you can picture in your head. Many people think investing is the same as gambling or playing the stock market. They imagine people yelling at screens all day, winning and losing money in seconds. But real investing is usually much calmer and much slower. It's not a casino, it's more like gardening. You plant, you wait, and you let time do a lot of the work. To understand investing, it helps to compare it with saving. Saving is when you keep your money safe for later. You might put it in a jar or into a simple bank account. The main goal of saving is safety. You want to be sure the money will still be there when you need it. Imagine you have £10. If you put it in a jar and leave it there for a year, you will still have £10. It didn't grow, but it didn't disappear. That's saving. Investing is different. When you invest, you want your money to grow over time. You accept that the value might go up and down along the way, but over many years you hope it becomes more than you started with. Saving is like keeping apples in a box so you can eat them later. Investing is like planting apple seeds, hoping that in the future you'll have more apples growing on a tree. Both are useful. Saving is for short-term needs. Investing is for long-term goals. One of the most common ways people invest is by buying something called a stock. A stock is simply a tiny share of a company. When you own a stock, you own a very small part of that business. Imagine there is a toy shop worth £100. The owner decides to split the shop into 100 equal pieces. Each piece is worth £1. Each piece is like one share or one stock. If you buy one share, you now own 1% of the toy shop. If the shop becomes more popular, sells more toys, and the whole business is now worth £200, your one share could be worth about £2. Your piece grew in value because the company grew. If the shop does badly, sells fewer toys, and is now worth only £50, your share might be worth about 50p. Your piece shrank in value because the company shrank. That rise and fall in value is happening all the time in the stock market. Why do prices change so much? Think about a market stall selling apples. If lots of people want apples and there aren't many left, the seller can raise the price because people are competing to buy them. If nobody wants apples and the stall is full, the seller might lower the price to get rid of them. The same apple can be worth more or worth less just because of what people want. Stocks are similar. When many people want to own shares in a company, more people are trying to buy than to sell. That pushes the price up. When many people want to get rid of a company, more people are trying to sell than to buy. That pushes the price down. Sometimes prices move because of real news. The company invented something new or had problems or changed its profits. Sometimes prices move just because people feel greedy or scared. For an investor, these daily moves can look noisy and confusing. But a long-term investor is mostly interested in what the company might be worth in many years, not just what happens this week. Now we need to talk about risk. Risk means that things might not turn out the way you hope. In money terms, it means you might lose some of the money you invested. There is an idea called the risk-reward trade-off. Usually, the chance to get a bigger reward comes with a bigger risk. Imagine you're crossing a stream. On one side, there is a safe bridge. It takes a little longer, but you will almost certainly stay dry. On the other side, there are some slippery stones. If you jump across them, you might cross quickly, or you might slip and fall in the water. The bridge is like a safer investment. The stones are like a riskier one. Some investments move slowly and don't grow very fast, but they are more stable. Other investments can grow quickly, but they can also drop quickly. Time can help with risk. The longer you stay invested in something sensible, the more time it has to recover from short-term ups and downs. There are many different ways people can invest. Some people use savings accounts and bonds. A bond is like a loan you give to a government or a company. They promise to pay you back on a future date, plus a little extra as interest. Bonds are usually calmer and less jumpy than stocks, but they often grow more slowly. Stocks, as we said, are tiny pieces of companies. They can be more risky in the short term, but they have the potential to grow more over long periods. Then there are funds and index funds. These are like baskets that hold lots of different stocks or bonds at the same time. Instead of choosing one company, you buy a small piece of many companies in one go. This is called diversification, and it helps spread out risk. In real life, many people mix these types. They keep some money safe for emergencies and invest some money for the long term in a mix of funds and other investments based on how much risk they can handle and how long they plan to invest. Even though this video is not financial advice, there are some simple ideas that many careful investors agree on. First, never invest money you need soon. Money for rent, food, or important bills should stay safe in savings, not in risky investments. Second, don't put all your money in one place. If you put everything into one stock or one exciting idea and that one thing goes wrong, you lose a lot. Spreading your money across different investments can reduce the damage if one part does badly. Third, expect ups and downs. Seeing your investments move up and down is normal. It doesn't always mean you made a mistake. What matters most is the long-term direction over many years, not one bad week. Finally, be patient. Investing is like growing a tree, not like winning a game in one afternoon. Time and consistency can be very powerful. Let's quickly recap. Investing is when you put your money into something, like a business or a fund, hoping it will grow over many years. It's different from saving, which focuses more on safety and short-term needs. Stocks are tiny pieces of companies. Their prices move up and down because people are constantly buying and selling based on news, feelings, and expectations. Risk is the chance that things don't go your way. Bigger possible rewards often come with bigger risks. Time, diversification, and patience can all help manage that risk. There are many kinds of investments, and people choose different mixes depending on their goals and how comfortable they are with risk. Investing is not about getting rich quickly. It's about understanding what you're doing, accepting some ups and downs, and giving your money time to grow. If you enjoyed this simple explanation, subscribe to Money for People for more easy money lessons explained in plain language. This video is for educational purposes only and is not financial advice.